Turn off your phones. I'm sorry, I couldn't help myself.
It was good.
And are there any public comments, matters within the jurisdiction of the board? I don't see any, so we'll continue on with our meeting and go to tab 7. Welcome, Lori and Bill. To talk about the defined contribution and deferred compensation plans of the MTERA.
Good morning, Mr. Chairman, Director Villa, members of the board. I'm Dory Schwinden, Executive Director at Impera. Thank you for the opportunity to visit with you guys today about an idea that I believe originated a couple of months ago in discussions between trustees and senior management from both the Board of Investments and the Public Employees Retirement Board. There are some fiduciary responsibilities that differ between our boards, but one major overlap is the duty of prudence to our participants to monitor and control record keeping and investment fees. The idea that we would like to explore is whether the Board of Investments could assume management of the investments in the 457B deferred compensation plan and the defined contribution plan to provide efficiencies, reduced fees, and overall better outcomes for our participants. Deputy Director Holohan has put together a brief presentation, which I believe is in your board books, to describe it's a high-level presentation to describe the who, what, and where those potential roles and responsibilities might accrue, and what processes we would need to complete to be successful. I'm sure we won't be able to answer all your questions today, but we look forward to a good discussion and also the continued consulting with our partners at RVK and Empower Retirement to assist us. Thank you, Mr. Chairman, for allowing us to be here today. And I'll turn it over to Deputy Director Holohan to go through his slide deck.
Thank you, Director Schwinden. Mr. Chair, members of the board, for the record, William Holohan, Deputy Director at Impera. The purpose of this presentation, as Dory alluded to, is just to continue our discussion with our boards, having had their focus on potential roles and responsibilities that both the retirement board and the Board of Investments would embark upon if the Board of Investments were to assume the investment management function of our lineups within the defined contribution plan and the deferred compensation plan. So for purposes of this morning's presentation, I'd like to provide some background on these two plans and then speak to those potential responsibilities and roles should such a scenario be pursued by our two boards. So if you turn to the first slide, from a background perspective and at a high level, in addition to the 8 defined benefit plans we administer at Impera, we also administer a tax qualified 401A defined contribution plan and a 457B deferred compensation plan. Now, the 401A defined contribution plan is a government employer sponsored tax deferred retirement plan that operates akin to a 401k style plan or a 403B style plan, in which employees contribute a statutorily mandated percentage of their paycheck to an account that is intended to fund their retirement. The deferred compensation plan likewise is a government employer sponsored tax favored supplemental retirement plan. This type of plan, a participant contributes pre-tax dollars from their paycheck, and the money is not taxed until they withdraw their money, usually for retirement purposes. However, I'll point out that participants do have the ability to make after-tax, post-tax Roth contributions as well within the plan. There's a low bar for participation in terms of participants in the plan. It's a minimum deferral of $10 per month. So we open the door for any smaller local governmental entity that wants to contract with us and have a low bar for participation.
Is that a statutory requirement or is that your rule?
That is our rule, and both of these plans are governed by separate plan documents that are adopted by the board that set those parameters.
Okay. Yep. So you adopted the $10 a month. That's not some requirement of the law.
That's correct.
Okay.
Yep.
Thank you. Bill, sorry to interrupt.
No problem. As you'll see on the slide, overall, there's over $1 billion invested by participating members between both of these plans, with roughly 14,000 unique participants. Breaking this down further, there's roughly 10,000 participants within the deferred compensation plan with about $650 million invested. and just under 5,000 participants in a defined contribution plan with roughly 410 million invested. As I alluded to, each plan is governed by a plan document that controls the governance and operation of the plans themselves that are adopted by our board. And then if you look towards the bottom of this slide, you'll see the current investment allocations chosen by participants within each plan. You can see at the bottom of the slide, we currently have a split between the two plans and how the funds are utilized by participants in terms of target date funds, which are age-based retirement investments, which allow participants to take more risk as they're younger and become more conservative as they age. We've got a little over half of participants in a defined contribution plan that are solely in target date funds, about 53%, while in the deferred comp plan, only about 16% of participants do that same methodology, with the majority of deferred compensation plan members utilizing core options only. Roughly 63% fall into that category. Now, in terms of core option utilization within the defined contribution plan, roughly 36% within the plan are using core options only. And between the two plans, roughly 10% of participants use what's known as a multi-tiered approach between core funds and target date funds in the defined contribution plan. And roughly 21% use such an approach in the deferred comp plan. Now, as far as participant fees, which is something as fiduciaries we're constantly monitoring, in the deferred compensation plan, there's an annual $10 fee per participant with an asset-based fee of 35 basis points and an annual cap on fees of $244. In the defined contribution plan, participants are charged an asset-based fee of 14 basis points on their account balance per year, which is deducted quarterly, and that overall fee is capped at a total amount of $280 per year. These fees flow into our administrative expense fund to administer the funds and cover necessary expenses. And in addition to those fees, of course, each investment option within each plan charges an investment management fee, otherwise known as an expense ratio, which appear in each investment options prospectus. So if you'll turn to the next slide, and really it's the next two slides.
Bill, will you just run those numbers by me one more time?
Yeah, absolutely.
Your charge is,
For the deferred compensation plan, we charge an annual $10 fee,
okay,
in addition to an asset-based fee of 35 basis points.
That was not a deferred contribution plan,
Deferred compensation plan.
deferred compensation.
457.
That's our 457 supplemental retirement plan.
$10 a year and then 35 basis points.
That's correct.
with a cap of,
With a cap of $244.
okay,
44.
and on the,
And
and on the 457?
that was the
was-
457 fees.
Oh, I'm,
401 is the other one, right?
Yes, that's
Yes.
correct.
oh, that's the 457.
Mm-hmm.
I'm sorry, I wrote it down wrong.
Now, on the 401A, the defined contribution plan,
Right,
participants are charged an asset-based fee. There's not an annual set fee.
oh, okay,
And that asset-based fee is 14 basis points. And there's an overall cap on fees of $280 per year. Those fees are set by us. In addition, of course, there are the expense ratios and investment management fees.
and are these set annual, do these fluctuate, or is this?
We do an annual fee review. We'll actually do a fee review this April. And we do adjust and set those fees at that time.
Okay,
So
and
they,
that, and you do so on the basis of your cost of administration?
That's correct.
Okay,
So that was my question. Do they cover your costs?
That's exactly right. That's what the intent of these fees are to do, to cover the cost of administering these things. Mhm.
have you ever done a calculation of sort of, then what's the average or in terms of basis points?
We have, I don't have that exact number with me today, but I can get you that information. Yeah.
What's your question?
Well, it's just sort of, it would be a really high level number, but just sort
Right.
of,
Okay.
That's
you know,
certainly,
how many basis points it costs?
that's certainly data we have. And
Average participant, if there is such a thing?
yeah, that's certainly data we have, and I can get you that information.
That somebody else,
Yeah, about what does that, do those fees end up totaling in terms of dollars per year at this point?
Yeah, Anywhere between north of $500,000 in fees.
Two plans together.
No, for the two plans together, we're probably over $2 million. Yeah, if we're speaking to, yeah, I guess I'm looking at it from a quarterly perspective too. So I'd say it's north of 2 million.
Combined.
Combined, yeah.
Right.
And I can get concrete numbers.
457, the 35 basis points is the average asset balance per participant, or what's that based on?
Yeah, the asset balance. That's correct.
Whatever that may be, Mark,
The
whatever their
the
balance
total
is.
asset balance
At a point in time or over?
at a point in time. That's correct.
Sure. See, Dan has got us really worried about costs and fees now.
Dan, it's all Dan.
It's all Dan.
Well, I think-
Otherwise, we just go, you know.
I'm sure that's not the case. We worry about fees constantly.
All right, I'm sorry,
No,
that's
thank
okay.
you. Thank you for
All
asking.
good, great questions.
and well, as long as I got you,
Mhm.
before what's your, tell me what you mean by core options, core option only.
Sure. So if we're looking at, I suppose, broader exposure to, Vanguard funds that we have in our lineup, in the small, mid cap and large cap equity arena. Yeah, and you can see those on the next two slides.
Okay,
And as explained to me by our consultant, a large number of folks in the deferred compensation plan originally invested in core options before target date funds were available. And that's probably one of the main reasons why they've stayed in those core options rather than shifting gears and changing. So that's largely why you see a larger concentration in those funds in that plan.
okay.
So do you have allocation of staff time that you charge those costs against? Or
We
how-
do.
So
We
about
have-
how much staff time do you?
Of our 46 FTEs, I'd say that at least 30 have exposure at our agency to dealing with issues related with 457 in DC, whether it's just ensuring deferrals are coming in the door, files are being transferred to Empower. And so we do have a whole budgeting process where we allocate time to hit that account, to assess fees accordingly.
But that's both benefit side and investment side.
That's correct.
Yeah, so
Yep.
there's,
And accounting.
Yes. And of course, on the timesheets, it reflects how many hours per time period the various staff are working on those issues.
So you can break it out between the plan administration and the investing.
That's correct. Yes,
Yes.
yes.
What, and then follow up to Carl. Target date funds. I've heard of that. I think I know what it is, but would like you to let
Sure.
me know whether I'm mistaken or not.
Yeah, I guess the simplest way to explain them, they're age-based retirement investments that allow participants to take more risk and also riskier asset allocation when they're younger, and then that allocation over time becomes more conservative with their investments as they age. We have them in more or less 5-year, the T. Rowe Price target date funds are what we currently offer in both plans. And they are counted as one option on this sheet, you'll see, although they're offered in 5-year vintages. And they run from the year 2005 all the way up to 2065, actually. This says 2060. So essentially what it allows for is someone that's investing that more or less wants to take their hands off the wheel a little bit, and they can predict when they're going to retire. They can pick a particular vintage to line out that date.
And of course, that would adjust the risk involved as well.
That's correct. It's a similar type of fund that you might see in a 529 plan, perhaps.
You know,
A 529 plan that people
Oh, yeah.
utilize for investing for educational expenses for their kids. Yeah.
If you like pictures, Bruce, page 39 of the RVK document.
Oh, quit bragging, they read the report.
Bert, I'm glad I told you yesterday I was going to take your lead. Through the RVK document was,
But it kind of
Oh,
shows
that's cool.
as the target date fund ages, how the investment changes. It goes from riskier, equities to less risk.
thank you.
And it's automatic.
The big stuff, yeah.
That's the basics.
So my son's education plan sold in 2000.
That well, huh?
What?
Worked out well.
What worked out real well?
Mr. Chair of the Board of Investments, don't tell me.
Don't
people
tell people, no, okay. Let's see if Lindsay can
Remember
scrub
the
the,
recording?
Yeah, I was gonna say, I can't hear you, but I heard the recording.
You might not want to.
Well, Bill, have we confused you where you are, or did you?
I think we're good.
Okay, good, thank you.
Okay, so the next two slides in the deck really depict our investment lineups within both the defined contribution and deferred compensation plans. And these lineups within each plan are similar, with the defined contribution plan offering 20 investment options and the deferred compensation plan offering 21 investment options. You'll note on these two slides that these options cover target date funds as well as passively and actively managed options, which fall into global equity, large, mid, and small cap equity exposure, broad international equity, emerging market exposure, core funds, high yield, as well as our stable value investment option, which offers plan participants the option of investing in the Montana fixed fund stable value assets. Now, the stable value investment option is managed by PIMCO on behalf of the retirement board, and it's an actively managed diversified investment strategy, which invests primarily in investment grade fixed income investments, government securities, and derivative instruments, including futures and swaps. And so suffice it to say, there is currently offered a fairly large amount of options within each plan.
Mr. Chair.
Yeah.
Is the stable value a guaranteed fund?
That's correct.
How, and do you pay insurance for that or?
That's correct. That's rolled into the cost of administration of the fund. Within this fund, guaranteed investment contracts, which are known as GICs, are issued by 3 insurance providers that we utilize. They are Voya, Transamerica, and Prudential, to provide assurance that future credited income to participants will not be below 0. That's correct.
Prior to 2008, Terry, there were probably 25 or 30 wrap insurance providers, but many of those got shook out of the business after that recession.
Just as a matter of interest, what is the rate on the stable fund right now?
I believe it is 1.88 quarterly rate.
A lot of these managers, are they long-term or how often do you change those or how do you change them?
We've had PIMCO for about 8 or 9 years. I would say they are one of 2 or 3 long-term managers that come to mind that have been in the business for a long time. Yeah.
And that's just on the stable fund. Were you asking about?
Well, this may be more in general. on these two.
Yeah, I mean, from my experience, I would say a lot of them are longer-term managers that are being utilized in the fund.
RVK probably would have a more detailed answer on that as well.
If you look at page 12 of the big book, and page 11 and 12, you can see some of their duration, how many plan performance review, how long they've been around, performance.
It's all right.
And you're just briefly describe the process for selecting these, and how do they get in this mix?
Sure. So we do have an advisory council, employee advisory investment council that meets quarterly. We review through RVK quarterly fund performance. We look at the performance of funds over an extended period of time pursuant to board policy that we have. We do put certain funds on probation. We do look at adding funds when there's a need. And that's through a formal voting process of the advisory council currently. That is just an advisory council to our board. Our board has the ultimate authority to decide whether or not they want to include that fund or not. But there is a selection process that takes place at that level with consultation with our investment advisory consultant, in this case, RBK.
Might I add that we've had on the advisory council, there has been occasionally Board of Investment folks, employees
That's
on
correct,
that
yep.
advisory council. Not always, but
Who's on that council now? How many members?
We have 14, if memory serves me correctly. All in, yeah, 12 to 14 at any given time.
Voluntary board advisory council as well. I don't believe they get per diem or
That's correct.
$50 board service fee, anything. It's all voluntary.
And so they screen with the help of the professionals and then a recommendation to the board. And then
That's
the board-
correct. Further discussion at the board level would take place.
And that's to add or to drop.
That's correct.
Thank you.
If we turn to the last slide in the deck, really focuses on the heart of the matter, for purposes of our discussion today. What this focuses on are the potential roles and responsibilities, both the retirement board and the Board of Investments would both continue and or assume in the event that Board of Investments were to undertake the investment management of the individual fund lineups in our deferred compensation plan and our defined contribution plan. So in addition to the Board of Investments potentially assuming the investment management of the lineups, you'll note on the slide that Empira and Empower Retirement, and Empower Retirement is Empira's third-party record keeper for administration of both of these plans, will need to continue their current roles in administering these plans from an operational standpoint. So if we look at the top of this chart, in such a scenario, Empira would continue to administer plan choice elections with our members, as well as individual 457 plan participation agreements and salary deferral arrangements. And by way of background, each new hire in a PERS covered position is given 12 months to make an election between the defined benefit plan and the DC plan. And as such, Empira would continue to receive, separate, and reconcile reported employer and employee contributions coming in the door into the appropriate plan, in this case, DC or 457. We do that on a daily basis. We would continue to transmit daily contributions and salary deferrals in a data file to Empower Retirement, which we do every day. We'd continue to deposit these contributions into our custodial account and remit these contributions as payment to Empower. In addition, if there were to be any changes in the investment lineup within these two plans, Empira would need to continue to notice plan members of changes in that lineup before changes are made. We drop down to the bottom of the chart. Empower would continue to offer the same services it does to Empira as a third-party record keeper from that perspective. It would continue to conduct its core record-keeping function related to membership accounts by receiving contributions and deferrals from Empira to invest within the fund lineup pursuant to participant directive. It would process enrollments for new members coming into the plans, continue to engage in record-keeping for purposes of reconciling participant data and records management. Also continue to offer client service representatives as point of contacts for questions that arise from members germane to their participation in the plans. Continue to offer third-party related communication services, as well as the production of written publications and forms utilized by Empira. Now, looking at the middle of this chart.
Could I just ask about Empower?
Sure.
Do they have a local office or local people, or how does that work?
They do. They have a local presence here. It's more remote during COVID times, but they do. We have a account representative, Chris Heisel, who is top notch, that is from the local Helena community, as well as various other representatives on standby that could be reached at the main Empower number at any point in time.
Empower was formerly known as Great West Retirement. You may recognize that.
So the relationship has been long-term?
Very long term. Yeah, we went out for an RFP about a year ago and contracted with them again.
Question, when somebody starts withdrawing their deferred comp, does a check come through Empura, or does it come from Empower?
Comes from Empower.
And what about the DC or the 401A money? Does that also come from?
That both come from Empower.
Thank you.
This might be an off question, but could you describe the website that's available to participants aside from the client or the consultant services?
That's right. Great question. Empower has a very robust website that's individualized for each participant. You can log in, view your account balance. You can make salary deferral elections. If you want to change a salary deferral, if you're participating in the 457 plan, it's completely automated. You can change your investment allocations online through that functionality. It's a full service website that our participants utilize very frequently.
And the feedback?
It's been great on their website. Yeah, it really has.
It's a pretty good website.
Yeah, you can do some modeling on it for future retirement purposes based on income you think you'll have, things of that nature.
Empower, I think, is certainly in the top 5 nationwide of record keepers. So they're a large respected company.
So board, so you get the money and then you send it to Empower
That's correct.
and they allocate it to the accounts.
That's correct.
Okay. And that stays the same in your scenario?
It would in my scenario, yeah.
So, in thinking about, if it's on liquidity requirements, you've got how many years of data now with this to have some idea on an ongoing basis what kind of withdrawal requirements they are? Because we take this on, John's got to be thinking about that, just like he does now, the retirement payments every month.
It'd be a little different, I think, in this instance, Bruce, because it's at an individual level, so they're making
Yeah,
that
I
decision.
know, and that's why I'm asking the question, because it is different. But it's going to affect your decision on how liquid doesn't it? So that, or
The Empower will have the cash, not the Board of Investments. So State Street and Board of Investments won't be received. The check will still flow from Department of Administration to Empara to Empower. If that individual decides they want to make a withdrawal, they will inform Empower and Empower will send the check. So for us,
but doesn't that on an ongoing basis affect how much money
So
you
we,
have to invest?
we would be, well, at least under current circumstances, and have not thought about this deeply at this point, but everything they have is public equities, public fixed income, liquid, they have liquid securities, liquid options here, right? So there are no private equity or, real estate type applications here where you're going to have to worry about, can somebody, they can withdraw from any of these funds at the options that they have now on a daily basis.
And it's their
Entirely
decision.
participant
It's their
driven.
decision, not
And
ours.
and so then who sells Empower sells
Power sells it. sends
Yeah.
it to them.
Empower sells it at that point
That's right.
Empower sells it and sends it to the
and
person
sends
who
it to
told
the
them to sell
person.
it.
Well, thank you, because you answered my question. Because in a certain way, they can, because these are public markets, they can sell it that day, so the participant gets their money that day.
They must.
But if you did offer something that was less liquid, then that would again be the participant's decision.
There, not to get too in the weeds, there are other plans that I've seen out in the world that offer, say, an illiquid sleeve of some sort, and then you might have something where you had to sort of think about the liquidity within these things, but we're certainly.
Long ways from that.
We're a long ways from
Yeah,
that.
we're a long ways
Yeah,
from
we
getting
don't,
to
that
that.
does not exist at this point in
No.
time. That'd be a separate
You asked
discussion.
this, and I was gonna ask next. But this is something that we do, that we invest in, that could potentially, long-term, be beneficial to the program participants.
Exactly.
There's a lot of
Yes.
coulda, shouldas, maybe will do's in there.
We'll talk a little
But
bit
if we
more.
do
about
that, it does
should.
raise exactly that
So-
issue.
Go ahead.
Sorry.
If I'm understanding this right, and this is really being simplistic, but really, the board would take over the role essentially that RBK is doing right now, right? Or we rely on them maybe for advice, but all we're doing, if I'm understanding this, is we're giving our advice, and I'm assuming the employer board would still make the final decision of what funds there is, or maybe that's something we need to discuss, but all we're doing is deciding which funds are there,
So high
right?
level.
And reporting on how they're doing. But we're not, I mean, when it says manage the investments, that's what worried me, but we're not really managing them. We are giving a laundry list to choose from. Correct?
So, Dory, let me take a stab. I
Yeah,
think
yeah.
We are not, we would not be asked to supplant RBK in this process. We would be asked to supplant the Employee Investment Advisory Council. So we would trade in our CFAs and KIAs for the lay volunteer board to advise on the investment manager lineup available to these employees. We would then develop an investment lineup available to them that they could choose, that they could buy and sell. And then over the long term, we would be able to potentially negotiate savings on their behalf, leveraging all of our assets, as well as, to Bruce's point, way down the road, say, hey, we have this great real estate sleeve. And for some lockout period, you can put some money in there and get a higher return. So you'd be able to take that illiquidity or that liquidity trade. But I don't think there's a scenario where we would ever have the dollar to start out with. We would not see that a single dollar in additional AUM on our side.
Right.
We would be an investment manager selection crew on behalf of these folks. Now, I don't think I would not recommend to this board that the decisions of this board go to that board
I was just wondering, I mean, yeah.
but
To be determined, that.
You know, this is kind of, I mean, this is just kind of flip it, but I think it's kind of funny that we're going to passive investment. And then we would be giving our advice on actively managed funds. I just think that's an interesting
That is
thing.
So. Okay. So if we did this and we take this in theory, right? We take this list of 21 options. And give your board the advice of whether to stay with all of these or switch some or whatever, right? Your board would make that decision, correct?
I think that's part of the conversation
Yeah.
as to whether or not we
mean,
manage their assets as a fiduciary on their behalf already within the DB plan.
Right.
I think the question that your board and this board have to determine is to what level do we assume a fiduciary duty to the beneficiaries of the DC plans? So do we make that determination and send the lineup to Impera for notification? Because you look at the core competencies and the strategic continuity. We do investments. We don't do benefit administration.
Right.
They do benefit administration, not investments. So we lean in on our respective strengths.
You have a shared fiduciary responsibility
Exactly.
in my mind, more so than it is.
Correct.
And that's exactly what the beginning of this idea was about. And you said it very well, Director Villa. I think there are some recent legal developments that also make this a timely kind of a decision. And Carrie's nodding her head. She's heard about some of these things that have come up recently. So, you know, I think bottom line is that we think it would be a good idea to pursue this. And most of the legwork is going to be done outside of the Board of Investments here to get these processes and these decisions made. So we're not trying to make it sound daunting to you, but I believe, as I started my introduction here, that our duty of prudence overlaps where we need to look at the fees and the record keeping costs for our participants.
Okay,
And I think you guys can do that better than the way that we're doing it right now.
I'm just trying to get who, under the, what you're proposing, who has the authority to set the menu?
Right now, it's the Public Employees Retirement.
Right, are you proposing that we do that?
I haven't got to a stage where I can make a firm proposal
okay.
about that, Mr. Chairman.
Okay.
This, I had a little visit with Bill last evening. And he said, well, what do you think a reasonable timeline would be? And I think an aggressive timeline to do this would be prior to the legislative session. And that would be about the most aggressive timeline I think I could follow to get that done. Again, I'm ballparking.
And I don't know if this is an appropriate question for me to ask. If it's not, tell me. All right, is your board willing to give up the role of picking the options?
Mr. Chairman, we have not asked the individual board members. I know that we've obviously spoken with our member here, and I'm not going to put words in her mouth. She can
Okay.
speak for herself. Certainly, our board chair is in favor of this. We have 4 new members appointed by the administration who are relatively new, and I'm not sure that they have a good grasp on all that we do in DC and 457. So I don't think that topic is mature enough to ask them.
Could I ask one, Carl?
Well, yeah, please.
Just sort of politically with no names or anything, but that advisory board would go away, the way I understand it, right? We would take their role, sort of.
I'm going to look at Mr. Hollahan. There are certain statutory hurdles that we would have to cross, but we would be willing to undertake that.
Okay, so I guess I'm worried about feedback,
Yes.
politically, I mean, would those people be willing to do that? I know it's all volunteer or, but do they want to keep their jobs?
Their roles.
Their roles.
Yeah, right. There are some who would, feel like they had a proprietary interest, no doubt. Some of the longer serving members, but there again, I think there are probably a majority who would say, hey, if a Board of Investments can do a better job for our participants, why would we get in the way of that?
Yeah, and I guess what I would say is, as fiduciaries, as you've heard, under our duty of prudence, we've constantly got to be looking for ways to lower expense ratios and fees. And if there's an opportunity to investigate that for purposes of creating better buying power with our participants and potentially setting up better retirement outcomes, that's certainly something that I would encourage our board to focus on.
And then, so to John, then the issue is if, just looking at the current lineup, we've got overlap with some managers that we have.
Yeah, I would say we have, we either have or have had most of the managers that are on this list and have, relationships with them in some way, shape, or form. That's not to say that, this is necessarily the lineup we might end up with if we
Right.
choose to take it on, but
And is it the theory of the staff that because of those relationships, we'd be able to
well, I think,
negotiate a better?
to me, and again, not having, haven't dived in and said, well, do this, that, or the other thing, but we certainly do this within, the rest of our portfolios where, what we're doing in the pension fund may very well be applicable to state fund, and state fund's getting a far better rate from a manager because we have pension money with them, we have state fund money with them, we have trust fund money with them. And that's a big check at the end of the day. There's clear economies of scale here. in some
Okay,
of
so
these
my
areas.
question is, but aren't these different because aren't these individual accounts?
That's what I was.
I don't think so, because
You
at the end of the day, you know, it's BlackRock or it's, you know, Newberger or whoever, and most of those entities, when you go talk to them, so as an example, when we talk to BlackRock and we have some equity investments there, the equity investments or the actual portfolios that we're in for the pension are different than the ones that we're in for state fund, because there are some different rules. You can't maybe mingle pension fund and insurance money, but they still look at that as assets under management with the Board of Investments, and we get a fee break based on our overall level of assets under management with them.
That's the key.
I served on EAC for, I don't know, 10 or 11 years. So I've watched this and I've seen how we chase institutional share costs. And we have $1 billion that we're collectively responsible for. And as one who was there for the members, I was always looking for a better deal. And for that reason, I guess I would like John maybe or Dan to talk a little bit about, could we get a better deal?
So maybe let me go high level for a second. And you should sit closer to me so you can kick.
Oh, is that right? You're asking me to kick you.
We'll get Aaron. Someone go get Aaron. So let's put ourselves in the shoes of the beneficiary. Because ultimately, both we and Impera have a responsibility and a duty to the beneficiaries, to those enrollees. And who do we want making investment decisions on behalf of those beneficiaries? If you're sitting in that seat with a DC plan, with a deferred comp plan, do you want a volunteer board of lay individuals making that menu selection for you? Or do you want a professional staff whose full-time job it is to screen and select managers, to negotiate contracts, to filter out all of the prospectus that come in and figure out what is the best fit for the options that that group of individuals want? Within our context, we are a perpetual fund. We are continuous. We will be around until the state of Montana no longer exists. EAC rolls over. It has different perspectives and different views, but our strategic asset allocation under the strategic lens we take with all of our funds, whether it be trust funds, STIP, whatever, our plans and our forward-looking strategy doesn't really ebb and flow all that much. That in and of itself is a value add. But we don't make decisions on GuideStar recommendations. That is just a different level of sophistication that we bring to the table. I'd look at the cost savings as potentials. We drive a hard bargain, as you all know, and we do our damnedest to lower fees whenever and wherever we can. Whether that is working with Impera to determine what that administrative cost is and whether or not there'd be a savings there, or working on, frankly, where I think our value add could be, is that those BIPs that are charged by the individual fund managers. That will take time. That's not a right out the gate thing. So from a continuity of governance, from an expertise of those in managing the lineup of the funds, and from the, let's say the odds are in the favor of us being able to get better fee structures than with our $25 billion in assets, than, as Diane said, $1 billion doing the negotiations. So that would be my high level lens on that. And I know John's smarter than me, so he can.
Can we quote you on that?
He does.
That's the first time he ever admitted it, but okay.
So what you're saying then is that what you think we bring to the table is the opportunity to produce a better list of options.
I think that is one
A
of the
potential.
two best things that we bring to the table.
Right, and then the second thing is a negotiation on the managers.
I would put that on as third. I think the
Third.
two biggest things we bring to the table is staff expertise that is currently not available and continuity of governance. That we have
Oh, I
what we
see.
look for.
Stability.
It's, we do fiduciary duty work on investments. That's our core competency. And that is not the core
Not in our
competency
basket,
of
no.
Emera. The third potential benefit is leveraging our $25 billion to the benefit of the $1 billion DC squared plans.
So can you actually, so these are publicly traded funds listed right here. So can you actually adjust the expense ratio specifically to these plan participants? Or would you have to like roll into new products to get a lower expense ratio?
I don't know for sure.
Yeah.
I don't.
I think it would be, part of it will be sort of, I don't want to call it a bidding process, but as we're opening up the menu of who's available. I mean, yes, they're publicly traded, but nobody trades on your behalf for free. So what's the spread on that?
And it's not to say that, you know, necessarily we could get the same, you know, basis point fee on these particular funds that we get on, say, you know, the pension fund one,
Mhm.
because they are likely to be, they will be different products because you know, aren't likely to be able to mingle those in the same way, but there's still leverage there. So, you know, what can we achieve? I don't know, but I'm reasonably confident that we can achieve some savings here.
Bruce?
Yeah, so all of the participants in these two plans are also participants in PERS is. Or are
Not the
there,
401.
The overlap is.
yeah,
the-
what's the overlap? And
Well, some of the people that are in 457 are also in the PRE.
are also,
Are also in the retirement system. Some of these people that are in the 401A and the 457 could be the same people.
That's correct.
That's correct, but
So-
also your people who are in the defined benefit plan could be in the 457, but they can't be both in the defined benefit and the 401A.
So your Venn
You pick
diagram of
between the
the,
defined benefit and defined contribution.
And we also have some situations where local governmental entities have only contracted into the 457. So we have exclusively 457 members that aren't in either DB or DC as well.
And that's fairly common with small.
One more time, sorry, Bill.
We do have some smaller municipalities that didn't enter into a formal PERS. DB or
Oh,
DC
okay,
plan,
oh, okay.
But did elect 457.
I got it, I got it.
Just 457.
So those that are still handling their own.
And there are school districts that have opted.
That's
in.
correct.
Yeah, so some school districts might.
so we've got strictly PERS employees, we've got PERS employees plus 457 deferred compensation. And then the separate category of
Defined contribution.
defined contributions who also could be
That's correct.
in the 401 side.
Defined contribution is
But
a.
nobody can be PERS and 401.
you can be DB
Correct.
or DC,
You
and
can't
either
be-
DB or
that's right.
DC can have
Correct.
deferred
All
comp.
right. Unless you're a federal employee, then you're in both since 1980 something.
So basically, we don't know about cost savings.
Correct.
Does it add cost? This proposal? Potentially?
Our expectation is that it would not, that it would reduce costs for the participants, Mark. And I think if we had a serious reservation about costs increasing, we probably wouldn't be sitting here today.
So it's the board's expertise that's primarily the kick.
That and cost savings, I would say. Yes.
Okay, but we don't know about cost.
That's correct.
until you start working.
The continuity, I had not thought of that argument, but I really think that is a real plus because we've all served on councils and they ebb and they flow and, I would argue, having served on them, they're a little more prone to headline, not hysteria, but, to move because they feel, oh, I'm responsible for this $1 billion and we better not make a mistake. Whereas I think staff that are trained and do it daily would be less likely to do that. Just saying.
That makes sense. Now, would we be reimbursed for the costs of John and staff's time?
We would have to be very distinct about how we build for these services because we cannot have cross subsidy between defined benefit and deferred comp or defined contribution. You cannot have one plan subsidize the other. And the accounting structure of Impera recognizes that. Their timesheets are very distinct. We would have some ministerial adjustments to do, but that's not.
And we budget in all those categories when we look at our budgets. I wish I had a copy of it with me, defined benefit, defined contribution, all the different areas.
Just like we do
That's
our
how they
cost
code.
allocation. It
So
would be
once
something
you're,
that we-
oh, no, you explained, never mind. You have RVK looking at, so in some respects, whoever asked earlier on about us replacing RVK, we wouldn't be replacing them, but in theory, we'd be doing some work that they're now doing. Because you got a lay board that says, what about this?
Correct.
John may look at that and say, no, that's a problem. And right now you got RVK doing
That's correct.
that. Okay.
So I know we're running out of time. I gotta watch Carl on this stuff, but is there some things that you want to make sure that you tell us today that we haven't discussed? I mean, this has been a good conversation, but I want to make sure you think we've covered what we need to know.
There's a lot left that we need to research. There's no question about it. And that's why I said an aggressive timeline, I think, to try and get the pieces in place prior to the legislative session. There has been a recent Supreme Court decision that I think is going to impact a number of these plan lineup decisions. And perhaps Bill can speak to that. It came down, I think, 3 Mondays ago or something.
State Supreme Court or?
US Supreme Court.
Yeah, members of the board, it's certainly one that you take notice of as a plan fiduciary. Recently, in a closely watched case, the US Supreme Court was issued a decision in late January to reverse and remand for reconsideration the US Court of Appeals for the Seventh Circuit's decision in a case called Hughes versus Northwestern University, which had dismissed a class action lawsuit against Northwestern University challenging the fees and investment options under the university's retirement plans. And they were administering 2 separate 401A defined contribution plans and actually utilizing an investment counsel akin to the one we use at Impera. And so the question at issue was whether the plan participants stated a plausible claim for relief against fiduciaries for breach of the duty of prudence and failing to monitor and control record-keeping fees, offering retail share classes rather than identical lower cost shares, and offering essentially too many investment options. They actually were offering over 400 in the plan at the time the suit was brought.
Well, that was our plan.
You were ahead of the game, Mr. Chairman.
So the Seventh Circuit had affirmed the lower court's dismissal of the case against Northwestern on the grounds that the plans offered a diverse array of prudent investment options along with allegedly imprudent ones. And in rejecting the analysis, the US Supreme Court's ruling makes clear that it's not sufficient to just simply offer a diverse array of investment options to participants, but that each of them, those investment options also have to be prudently selected and monitored. And that applies for expense ratios and record-keeping fees that we even assess. So these things are being monitored among the plaintiffs bar out there.
So there's a claim.
There's a claim.
There's a claim.
There is a
There's a claim against the administrator that you're doing a bad job of offering us options.
That's correct. Monitoring fees, are there opportunities for lower fees? And
Are we offering too many options?
we're offering too
Offering
many
too many or
options.
too few. Is there-
RBK, I think, has some, what would you say? They have some advice on that topic.
Yeah, we've certainly considered simplification of our
Right.
menu. I think we have a pretty robust one. It's kind of a stylistic approach that we have. And certainly something as the advisory council and our board has looked at, we certainly are looking at that issue. of
Okay,
simplification.
so, I mean, so I think what we probably ought to do with the last 3 or 4 minutes we have is see how do we do, what's the next, what do we do next?
Could I ask one question? Because we've talked a lot about RBK, could we just have Mark or somebody say, or anything they want to talk with you?
Gonna go through their.
Yeah, I was gonna jump in on I tried to stay out of this because I'm not the consultant for Ampera, so I just, wanted to make sure I stayed in my lane here, but I think Dan said it well. I think at the end of the day, the goal here is to do what's best for the beneficiaries. And the decision factors that seem important from my perspective are the strategic continuity and the investment expertise that I'm not as familiar with Ampera, but I am familiar with the board, and you do have a good process and expertise both in terms of the board and the staff that is potential advantage. There are some possible fee synergies too. Those are a little less clear in my mind. I just don't know the numbers, but there's some potential there. And then I was going to jump in with respect to simplicity of the plan. I am familiar with, I know there are some recommendations to pair the lineup already, which I would wholeheartedly support. There are a lot of costs to complexity in DC lineups that often they're qualitative. I don't have the study offhand, but not only does complexity lead to decision-making that is not, and fund selection that's not in the interest of investors, the best interest long-term of the investors, but there's also a relationship between, there was a study done, I think it was about 15 years ago, on the more funds you have in a plan, the more daunting it is for people to actually participate in the plan, which is the most important thing. So that is a very important issue. And again, we're aware that there was already recommendations to pair the lineup, but there are real costs to having excess complexity in a plan, and it's good that you're moving in that direction. I don't know if that addresses some of the issues, just high level. I think you're thinking about the right things. Any questions, any other questions? I'm here to answer.
Oh, Mark, are you, do you ever see RVK making some type of recommendation to either board?
It's kind of a tricky, it's tricky to ask. If we do, we're gonna have to work together because I'm not familiar with the Ampera side. I think our preference is probably not to. I think articulating some of the decision factors for this board to take into account, I'm comfortable doing that right now. It's hard to make a recommendation on which one makes sense. I think that's a governance issue that is probably best made by the board without a discrete recommendation from us. But we can think about that. That's my initial inclination on the response.
This just plays into the timeline, but are there legislative changes that need to occur if this were to all happen?
Likely.
Okay. So aside from asking you guys to be available on April 20th, which is when we meet next, right?
Yep.
What else do we need to do today? You've given us a lot to think about. It's a lot of information. And This is good stuff.
Thank you.
My real concern is, are we creating additional liability for Board of Investments by doing?
Just $1 billion more than
So, but I mean, plaintiff's bar is out there. I mean, are we?
not that there's anything wrong with it.
So let's look at it at a broad context. Let's play out that Supreme Court decision on behalf of the entire state and the joint beneficiaries, because some of their 457 enrollees are our DB enrollees. Let's assume a claim comes forward saying, hey, wait a minute, you have a volunteer lay board administering the investment options that are available to me. And you had the opportunity to move it over to high-level expertise, and you didn't. Then there's gonna, I mean, if that Supreme Court decision and the Seventh Circuit plays itself out, I'm not a lawyer and there's only one in the room, you guys are gonna have to make some other decisions on how your investment decisions go. And it's either us or someone else.
Correct.
So
But I would just add one thing maybe to think about when we were talking, and this isn't to say right, wrong, or otherwise, but when we're thinking about who would have the ultimate decision-making authority from the boards, kind of to your question of who's taking on the responsibility there for the lineup. I think one thing this board should at least think about is if we're only making recommendations and then we had to take it to the MPARA board, I would have some concerns about, well, what if they're rejecting our options and then we have to expand our set sort of outside of what we might normally be doing? That might put more work on staff to have to accommodate. Perhaps their board's views are different than this board's views. And so I just think that's something that ought to be, under consideration.
So what's the next step?
Mr. Chairman, since we're going to revisit this in April, right? That's the idea here. I'd like to know what is the impact to the Board of Investment staffing and that sort
I
of thing.
think we need to have a discussion.
Because ultimately, on both these plans, it's a choice of the individual where they want to put their investments, right?
Right, yes.
All the board would be doing is saying, here's a lineup that we would recommend.
here's a lineup that we would recommend. And the backup of that would be, and here's the contracts under which that will be. So here are the fee structure for that. So they may look at that. Do I go with this 5 BIP program at this performance or this 3 BIP program at this performance?
So that's another thing that we need to understand, I think, Mr. Chairman, if I might.
No, please, that's what I'm trying to.
We need to understand where the savings from those managers might occur and why we might get a better deal for what's currently the cost for those. Is that something that we can look at?
So here's the weird thing. We would be doing work on DC and deferred comp under our current cost allocation methodology, which we can't do. So
We
we'll see if
can't determine those.
we can't determine those cost savings at this point. I think the
Unless
decision.
John wants to stay late and volunteer.
It's already staying late.
You said about claims,
Huh?
what kind of claim would he have then?
Well, no, he's volunteering,
Okay.
which as Bill knows is a very easy thing to do with employees, right, Bill? Okay, well, we'll figure it out, but are you guys around on April 20th per chance?
We'll make it happen, Mr.
Okay.
Chairman. Thank you for your time today. And I would suggest that some of this legwork we'll be doing to come before you on April 20th as well. I think we'll be working with RBK to try and map out more of the process and procedures so that that's clear. They have expertise in doing that. It's perhaps not Mr. Higgins here, but Ian Bray, who we've been working with at the EAC level, et cetera. They have experience in doing this with other public plans, so I think we'll be utilizing them to come with a little bit more fleshed out map about how we can get there if we want to choose to do
Okay,
so.
that'd be great.
And legislative changes, if that's.
You know, Bill and I were just talking about that while you guys were discussing it. There may or may not be
Okay.
a need for that.
Thanks, guys.
Thank you. It's always a pleasure to be
Yeah,
here. Thanks for the
great to
time.
hear from you. And why don't we take a break until, let's take 15 minutes, so till 10 out. Good job. Back on track here, and the meeting's in progress. Tab 8, short-term investment pool. Deep dive. Who's in charge?
I am.
Of course you are. I'm surprised I even asked.
Is that okay with John?
Right, I hope so.
Again, I'm surprised you even asked.
Mr. Chairman, members of the board, good morning. Today, I won't be cruising through the largest pool at BOI. We will take the time to do a deep dive, take some extra time to look at STIP. On page 2, always like to remind everyone our focus is safety first, liquidity second, and income third. Preserving the principal, we always are striving to achieve this since we transacted a dollar in, a dollar out. If we lose money, that becomes difficult. We also want to provide all of our STIP participants with one-day liquidity. There are lots of known outflows such as pension payments, paydays, OPI, but there are also lots of unknown transactions such at the state level, especially sometimes John wants to rebalance quickly. So we always want to have that liquidity available. We'll move on to page 3. STIP had over 1,200 transactions in the calendar year last year, and it was in excess of $44 billion. This number grows every time I do this presentation. And just to say, you know, those are really big numbers. It's also a lot of time involved in that. So I like to bring that up. And I think you heard from me enough yesterday, judging by the way this meeting started. So now I will hand it off to John Carpenter and Kelsey to talk about the risk in the
Could
portfolio.
I ask one question? Because you do mention the reserve balance there.
Yes.
I know we adjust that occasionally, but do you feel comfortable that our process to maintain that balance, and is there enough in there, or is there too much, or how do you feel about the reserve balance?
I feel comfortable with it, knowing that a lot of the money that is in STIP, so this 0.87 is maybe slightly lower than I would hope, but since so much of that money is ARPA and CARES fund money that will be spent when the state spends it, that you know, the denominator effect that would be significantly higher once that is an outflow.
And remind me again, I mean, if this, without the ARPA money, and
Yeah.
what
Probably.
number are we looking at?
What's the average balance?
Yeah, it'd probably be over 1%.
And that, you're comfortable with 1%?
Policy
So-
says 1.15.
I
Yeah.
think is the max before it was shut off.
1.15, we shut it off.
And so we are currently reserving right now, even with the low yields of last year. And, you know, now it's getting better, but
Part of the issue that you'll recall is that, you know, when rates drop to 0, pretty hard to
We stopped.
be reserving, and we've stopped off and on. I can't remember where we're at the moment, but
It's a flat
you know,
dollar amount.
as
opposed to a
rates
percentage.
rise, I guess the point is we have more ability to reserve.
Some of
It's
those
less
old
significant.
SIVs that are slowly paying us money, are they still doing that, or where are we sitting with
So
all that?
one of them paid off or we sold it, I should
Yeah.
say. That was
So you'll
a
recall,
few years ago.
we still have some nominal assets from the legacy Orion
Okay.
SIV. The dollar figures we expect on that are nothing to speak of. Won't make a basis point.
I haven't looked recently, Jack, but I mean, we.
That's kind of what is expected. I mean, there's, I think I at one time thought we'd get zero, so.
Yeah, with most of those Orion assets, remember, we took them all in-house. And I think there were something like 100 assets underlying. And last time I looked, there were only 15 or 20 left and they were all still paying down for the most part. There weren't too many that actually didn't pay ultimately. It's taken a long time.
Yeah.
Can I ask, Kristen, how many participants are in STIP?
I would have to look over 101.
We'll counting local governments a little better than 450. The large majority of those being the local governments.
Say that again, John?
Counting the local governments, there's a little better than 450 participants in them, and you know, it's probably close to 300 local governments.
Okay. Who was?
Yeah, I know we divide and conquer, so if we want to move to slide 4, I'll talk a little bit about credit risk. So when we talk about credit risk, we're talking about the quality of the issuer. Basically, are we going to get paid for what paid our coupons and ultimately principal at the end of the term? Again, our principle is safety first, so we try to evaluate credit risk by limiting the number of funds by issuer. So currently our $6.5 billion is distributed across roughly 50 issuers, about 170 different securities at this time. And again, that includes our treasuries, 3 different money market funds, and our DDA account that we hold at State Street. We use the rating agencies to evaluate risk. Every purchase must have at least two ratings from agencies, and they have to be the highest rated of each agency. So for instance, S&P calls it A1, Moody's calls it P1, Fitch calls it F1. So we're evaluating that before we make the purchase. We also have our internal metrics. So we're reviewing at least twice a year the credit quality of the issuer, making sure that as a fixed income team, we're comfortable with the fundamentals of the companies that we're buying paper from.
So in the big crisis, my opinion of rating agencies is they're worthless. So do you agree with that? And apparently not. But how much emphasis do you put on that?
Right. That's a fair question. And a good example is we'll take Disney in March of 2020. So the rating agencies still had them the highest rating. We as a team evaluated and said, well, there's a lot of risk. If you can't open your amusement parks, perhaps we shouldn't be buying that paper. So we made the move to remove them from the list before the rating agencies did. So we are considering, our opinion. We don't wait necessarily for a rating agency to jump first before we make
So
that call.
the rating is on the issuer or on the specific issue?
For the short-term markets, and Kirsty can correct me, it's issuer, and then the longer term, so anything outside of 365 days, they'll evaluate the actual issue.
And granted, when those longer term roll inside, they still have a longer term issue or ratings. So,
I'm sorry, what did you say?
so say we bought a 2-year floating rate note. If it rolls inside a year, it still has that long term issue rating. So on occasion, you will see it instead. But for the most part, it's the issuer.
And Jack, I would just add that we use the ratings as a screen. But, assuming it's rated A1, P1 or the equivalent, that means it's in our universe.
Okay, so
But we're using our process to select from
Because I know some of those ratings were the highest they could be in.
Also, as part of the credit risk, we have our STIP approved list. So this is reviewed by the risk management. So any member can bring a name forward if we're interested in buying the shorter term paper. And again, as a collaboration, every member of the fixed income team has veto power. So if we're not comfortable with Ramasco's suggestion, any one of us are, free to speak up and say, how about no? So we're reviewing those at least twice a year. And we loop Dan Zarling in on those meetings. He's looking at credit metrics as well. Christian has a template built out that pulls information from Bloomberg. So, we're reviewing our STIP name. That's not a, once you're on the list, you're good forever. We're reviewing those consistently.
You review the whole list or you review each name twice a year?
We review the list of issuers. So yeah, any banks, any commercial issuers, we're looking at those. Again, normally it's okay, but again, we have made changes occasionally, 1 or 2 names, I would say probably every 6 months on average, so. And then just looking at the graph, this is a visual representation of risk over T-bills. Yeah. Got to see our picture there. So again, that just shows the spread. If we can, it's not much to look at. Basically, interest rates. 2020, we dropped to close to 0, like we talked about. The benefit of STIP is that we're actively managing credit risk to get paid for taking a little bit of risk, again, while preserving that dollar value. Moving on to slide 5, we'll talk about market risk. When we talk about market risk, we're talking about macroeconomic factors that would impact our credits. What we're looking at here, and a very real example, is the global pandemic of 2020. So we were able to, through mitigation of market risk, not have to draw down the STIP reserve. We didn't have any paper that went bad. So that was indicative that our process works. We manage market risk by looking at diversification. So we manage that by looking at maturity limits. So for asset-backed commercial paper, we have a 90-day in limit. For any fixed rate securities, we're 397 days in. And then any variable rate, we're 2 years and in. So never any commitments outside of 2 years on that.
397.
John's lucky number.
How does that,
Yeah.
what's that?
That's 13 months plus a day for the leap year.
Oh, well, that's.
Wasn't that obvious?
I forgot the leap year.
I was off by 1 day, right?
So that's 2A7 money market fund talk, and we want that because there are issues because the market lives by that day limit. So we didn't decide that was a cool number.
Although it is a cool trend.
It is a cool number.
So we'll look at just the graph here, and you'll see the assets by type, and this is as of 12/31. Our highest category is asset-backed commercial paper. We like these programs. One, it's 90 days in, so we can react to changes in interest rates. Oh,
Well, Dan can do that, can't he?
Do this? I don't know how.
at our pictures.
There. Right on.
There you
Thank you.
go.
Now you do.
I knew. I learned that on day 398.
So asset-backed commercial paper. So these are 90-day programs collateralized by some kind of security. So whether it's loans, equipment. They're also typically banked by or guarantored by a bank. So we have another layer of protection there. So we see pretty attractive rates 90 days in. So that's our highest concentration. Next is government and agency. So this would be not only our T-bills, but also Fannie Mae, Freddie Mac, Federal Farm Credit Bureau. So guaranteed implicitly by the US government. So that, again, we're a little bit of comfort there. So that's our second. And then the third category, corporate commercial paper. Take this call here. And then, yeah, so corporate commercial paper, again, looking at the 397 2-year for floating rate, relying on credit agency ratings on that. And also, because we're only buying the max of 2 years, typically these corporations, they have to have the higher credit rating. And if something goes bad, they'll probably still be okay for a couple of years before they completely go belly up. So that's kind of our approach there. And I'll turn it over to Kelsey.
One question, why don't you guys have taxable munis or?
There's just not enough people on our team to cover the credit for that. I mean, that's a whole nother layer of going through the names, approving them, and there are 4 of us, and we also do the long-term portfolios, so it's just a time management.
I guess. We talked about it from time to time, but. It'd be challenging too. There's just probably not enough consistent
Size.
issuance
Yeah,
from
consistency of
different
issuance and
issuers.
size sometimes.
Yeah, that would be such a challenge for that.
Congratulations, you found a way to ask for another FTE
Without asking.
without asking.
Even I'm gonna say no to that.
You owe
She's got
Jeff,
up.
you owe Jeff at least one dinner.
Absolutely, thank you.
Starbucks. Now you're ponying up.
Okay, so moving on to slide 6. Good morning, Mr. Chairman and
Hi,
members of the board. Liquidity risk. This is the risk that maturities and money markets are insufficient to meet client redemptions. Or said another way, the risk that the price that we can actually transact at is different than the market price. The key point here is we never want to be forced sellers. As Kristen mentioned, with OPI and pension payments, STIP redemptions are generally predictable and follow stable patterns. Increased local government participation may increase volatility, which we'll look at in the graph below. But first, I just want to mention that we work closely with several different teams, both internal to us and external to us. Internal accounting and ops spend quite a bit of time. Kirsten mentioned 1,200 STIP trades. That's in addition to several other trades we do in the long-term portfolios. Each one of those is a separate transaction that has to be accounted for, booked, and settled, and that can take quite a bit of time. So in the graph below, local government as a percentage of STIP, you'll notice in the first half of the graph, twice annual spikes attributed to property tax revenues. Around 2016, there's increased activity both with the rise of property values and rising interest rates, providing more money for local governments. Then you'll see in 2020, there's no longer a semi-annual pattern due to government stimulus funds like ARPA and CARES Act. So overall, you can see the correlation here between increased activity and increased volatility.
I ask, on local governments, how many of them use us? I mean, they've got other options, but are we kind of the first ones they like to use, or how's our reputation with those government agents?
I would look to.
Yeah,
answer
so
that.
I would say, Jack, that we are well received. The largest counties and cities have significant funds. For instance, I haven't looked at Missoula County lately, but they were over 200 million in the fund at one point. So
How about Yellowstone? They were.
So Yellowstone's back, and they fluctuate a little bit. But both the city of Billings and Yellowstone County have large balances, often approaching 100 million.
Is there a percentage of local government, or is there, that would cause you concern about volatility? I mean, is it, if it gets over 50%, would that start bothering you, or
I'm gonna defer to Kirsten as the actual manager. She's the one that gets bothered.
Yeah, right. Yeah, I would say if the majority of STIP were consistently local governments, we would probably need to increase the liquidity in the portfolio. The government agencies, they aren't sending out 10, 20 million with a day's notice regularly. They can't do a run on the bank because they have no other options. So the state doesn't. And so I guess that would be the mitigation for high local governments would be increased liquidity in STIP.
Just, and I don't want to go too far with this, because do we have the ability to say to local governments, we're capped or something?
Well, the former executive director did once. I don't think statutorily we have the ability to say no unless there's some sort of mitigating circumstance. And frankly, I don't know that we want to be in the marketplace with that, call it a hammer.
Right,
How can I help?
right. And then the other question I had on this is that do we, for lack of a better word, market STIP to local governments or just?
We'll take them as they want to come in, happy to welcome them. If they have a better option somewhere else, they're absolutely free to go there, but we don't market.
So local governments are not required to use Board of Investment STIP. They could go out to wherever they wanted to go.
Yes.
And that's the same for any long-term investments that they have a choice.
Yes.
Okay, moving on to slide 7. Interest rate risk. This is the risk that the value of the portfolio will decrease due to movement in treasury rates. This is a topic of constant conversation amongst the fixed income team since the Fed will likely raise rates this year and probably very soon. The way this looks is that when interest rates are rising, the portfolio can miss out on additional yield. A tangible example of this is, say, 1 month ago, 90-day commercial paper was yielding 15 basis points. And today, let's say it's yielding 45 basis points. If we invest a month ago, we're stuck at that lower yield. So conversely, when interest rates fall, the portfolio will reinvest the proceeds at a lower rate. So the opposite of that example is true. A security that yielded 45 basis points matures, and we can only reinvest the proceeds at 15 basis points. Interest rate risk is usually less than credit risk in STIP because of its short duration. And in the graph below, this is the change in 3-month treasury yield by basis points. Historically, there's greater volatility until it held constant after the global financial crisis. And you'll see the sharp decline in 2020 marks the beginning of the pandemic. And I'll turn it back to Kirsten.
So I got a question. So several meetings ago, you guys changed the duration target to, or the max duration, I don't know if it was the target, to 120 days, right?
Yes.
Have you guys shifted that back with the recent rise in rates, or are you still pushing out towards 120 days?
Yeah, so John is going to talk about this a little later, but
Oh, okay.
essentially we have that room, but we have not used it.
Oh,
Because they need more people.
Yep.
Just one.
Great. On slide 8, this chart shows you the influence yields have on the performance of STIP. You can really see the tracking of the performance, the green line, following in sync with the net yield of STIP. There is a slight lag, and that is because the performance is annualized. I will point out, looking at this chart, you're like, wow, yields are so low, and they've been so low so many times. Well, last year was a very low yielding year for STIP. And we still made over $8 million for the STIP participants over the year. So I mean, I think that's real money. When you're talking about billions, maybe not, but you know, quite a bit. So point that out. And then on page 9, Kelsey and John did a great job talking about the risk in STEP. They're taking a larger role in operating STEP, taking a little bit of time away from me, taking turns managing once a week, which is really helpful. And it also kind of helps build the muscle memory of running STEP. There's a lot of moving parts. There's a lot of weird things that can happen. And we are, you know, aware of the bad burrito scenario and STEP and so on, everyone on the team to be able to take over at a moment's notice. And since they've done such a great job, I want to further highlight their competency with a Bloomberg demonstration.
Pause so that John can pull up Bloomberg screens.
Testing his
Yeah, that's not my.
competencies.
Thanks.
Okay, so we'll start our Bloomberg demonstration with informational screens. These give us an overview of what's happening in the market each day. We start our days by looking at some of these screens, for example. The first screen is the eco screen. And this is a daily economic data release. These change every day. And so at the top, you'll see today's date, 2/17. And starting with building permits, this is a leading indicator of health of the US housing market. Today's results indicate that the hot housing market remains hot and demand is outpacing supply. We can correlate this with ongoing rising inflation. And John Putnam mentioned yesterday that the housing market is a driver for the economic cycle. We also see building permits lead housing starts. This is a further indication of growth in the economy. Today, housing starts declined for the first time in 4 months. They're backlogged. This could be because of elevated material costs and limited skilled labor, as well as Omicron effects. Also looking at initial jobless claims, they came in above expectations. This was a surprise. When we look deeper into the information, these are just numbers, but context is important. So the increase here was due to concentrations in certain states. Continuing claims came in below expectations. And like I mentioned, the most important part is, what do these numbers mean? You know, we look to context, read additional articles, and discuss or analyze these numbers ourselves to give us an idea of what the market might do today and tomorrow. Using initial claims as an example of how data points affect our decision-making. If initial claims are actually down, which they're up right now, but if they were down, this is good for the economy. So the market may rally, therefore bonds may sell off in favor of stocks, driving bond prices down and yields up. But I want to point out that these relationships do not always occur as we expect or we hope. The market does not operate in a vacuum. So moving on to the FIT screen, this is for fixed income trading. I will point out the actives tab. This is where treasuries of various maturities are currently trading. For example, you'll see the 10-year. It's been hovering around 2%, and right now it's at 1.982. That's higher than when I checked early this morning when I got into work. Since we buy T-bills and STIP, we'll move to the bills tab. And on the far left, you have T-bill maturities, and then to the right, going across, you have bid ask price and ask yield and the change in price. And we like seeing green numbers because that means price is down and yield is up. So moving to the BTMM screen. For treasuries and money markets, on the upper left-hand corner, you have the Fed funds rate at 7 basis points. And just below that, we have 30-day and 90-day commercial paper. And these give us a point to compare to. If I were to say, look at purchasing a security with 52 days to maturity, I can look at these numbers and do a calculation and see if it's an attractive rate comparatively. So from here, I'll turn it over to
So
John.
the commercial paper is, that's an aggregate rate? I mean, what is that?
That's based off of bank commercial paper, the highest credit quality. Bank of America, corporate paper, 30 days, 90 days. Not Wells Fargo.
I get it. Thank you.
So if there's no more questions, John will take it over and go through more screens that help us make some decisions and
Are
purchase
you gonna
securities.
buy something today or anything?
If we have time, we will.
Kirsten said no.
Yeah, sorry.
No.
So
no, we don't
ruin
have
your
time.
fun.
Kirsten said we don't have time, or Kirsten said we're not buying?
For us, it's the same. We'll take you now to the boom screen. This is kind of the fun part of our job, right? So we come in the morning, Kirsten and I start at 5:30-ish, depending on coffee intake. And once we get a feel for the screens that Kelsey presented, now we can go out on the market and look to typically replace maturities. Sometimes, there's large inflows from the state where we need to invest additional funds, but primarily we're just rolling maturities from day to day. So the initial boom screen presents between 2,000 and 5,000 individual securities that we could invest in. Now, obviously, not all of these are available to us for different reasons, whether it be the maturity, the type of investment, the issuer, if the issuer is not on our approved list. So we have a filter built in to take this from about 5,000 down to a couple of hundred. So this is our STIP filter. These filters are built by our operations team, again, based on our STIP approved list and the other investment policy statement restrictions that we have. So this narrows it down so that we don't buy something that is not on our list. If we're looking, so just you can see the different colors. So white is new issue or primary issuance. These are issuers that are out on the market this morning looking to get some paper out. We like these. It gives us you can see a lot of the white names have a maturity date that's a range. So we can work with the brokers or the issuer directly and say, okay, we have a pension payment going out on April 14th. So let's buy some Anglesey, on that particular date, or maybe payroll is the 12th and that's the date that we need. So going back to liquidity risk that Kelsey talked about, this is kind of how we manage that, is matching up our cash maturities with cash outflows as best we can.
So that's the 28 to, or 15 to 27 on the top line?
Exactly. Yeah,
And is that negotiable, or is that?
It
Or is
is.
that you have to go find one that's?
No, so these are issuers that are active. So we work, again, Kirsten has some relationships directly with them, but typically we work with the dealer. So you can highlight that column. You can see, so this morning, RBC and Boney Mellon, are representing essentially Anglesey out in the market.
So, but my question is, so then you get a hold of them and you say, we want 16 days.
Exactly. So we would go to our contact at RBC and say, we would like Anglesey at, 7 basis points, and we want it maturing, on.
There it is.
On March 17th. So we're going to Butte for some celebration. So you got to match, right? Match outflows.
Kelsey needs cash. That's right. And
So-
then, okay, so then what?
So in this instance, if we were buying today, we would submit that bid, or we would work, with an intermediary who goes back and forth to the desk and would say, can you give Montana this paper? And they'll either say, yes, you're good, or no, we can't. Also with the new issue, we try to obviously earn more. So we would possibly bid back. So if they have it listed at 8 basis points, we would say, can you do 9 for this date? And again, because fixed income doesn't have feelings, we're okay with rejection. We kind of get used to it. So
Yeah,
we
do
get
you
told
get a
no a
yes or
lot.
no, or do you get a counter offer?
Depends on if we're only asking for a basis point, it's yes or no. Sometimes we'll ask for 2 and we'll get 1. We consider that a win.
How long does the average transaction, everything you're talking about there, take?
It can take, less than a minute if it's all
Yeah.
done here on Bloomberg really quickly. Sometimes I'll need a date that isn't listed at all. That could take a couple hours for the issuer to get back to me and say, yeah, we'll do that, or no, we don't want that. So, there's quite a bit of
How do
negotiation.
they get back to you? They get back to you on that screen?
We have a chat, so it's kind of like a group chat, like on text messages, but it's all through Bloomberg. We call them IBs. So instant Bloombergs.
So if we sent this out, so if we clicked here, they could accept it electronically and it's a done deal. And that could happen in a matter of seconds. It would happen in a matter of seconds.
And once you do that, then you're committed.
Yes.
You can't come back and say, well, in that case, we want 9.
Yeah, right. Yes, although, you do have kind of a handshake agreement with the brokers that if there's an honest mistake that's been made, either our side or their side, then we'll break the trade.
No, okay.
So the post quantity, so in this example, you would list at $200,000. Is that it? Is that what that post quantity is?
That's how much
So we can
they,
change this amount. Right now, it just defaulted to $10 million worth.
And if you put in that bid, you'd be bidding up for $10 million.
Yes.
Okay.
So is there any competitor to Bloomberg that does this kind of stuff? I mean, I know Bloomberg is pretty good and it's pretty expensive, but.
We are working on a relationship with TradeWeb, and TradeWeb does trade asset-backed commercial paper. And so that we're not live with them yet. I think it's still kind of in legal negotiations. And so once they're live, then we'll test to see where we're getting the best execution.
So that's one. Are there others?
No, that's about it.
Okay.
And I should say BlackRock probably does it, but that using their program is a cost, a significant cost.
Just like the Bloomberg's cost, right?
Yeah, right. Whereas the TradeWeb I was talking about is a fairly minimal cost.
So Kelsey, how long does it take you to get comfortable with the idea of pushing that green button? No, seriously.
Yeah, well, there's a lot of double checking. I'll flip between different screens that John will discuss, compliance screens and I typically, before I push a button, I do a double or triple check just to make sure that I'm confident in that. But it can take a few hours in the morning to kind of look at what the market's doing, look at what's available, look at how much cash you have. But the more frequent that we trade, the more comfortable you get, at least with some of the internal insecurities, maybe.
Right.
You'll always have that external pressure because we don't want to make a mistake. But it helps with time. But I'm still a little anxious each time.
I bet. And then in terms of, you said if there's something extraordinary happens, you break the trade, are you all authorized to break the trade, or does that have to?
yeah, it's also, if we break a trade, we have to go into Bloomberg and essentially cancel the trade on our side, and operations also gets involved with releasing that. And if something goes wrong in STIP, it's no secret. Everyone in the office knows because, you know, like operations, accounting, risk management, everyone gets a notice of it. So you can't hide anything in this
Very
portfolio.
respectful, and we
Yeah.
would never make fun of that person if something. happened.
Well, what about your relationship? I mean, I assume you gotta worry about your relationship with the brokers too.
They understand that we're people though, and we make mistakes
Right.
as they do as well. So.
For you specifically.
For me, a little too recently, but you know, I can think of a handful of times in my time at BOI that I have had to do that. So it's a pretty rare occasion, and we forget how to undo those trades every time. It's so rare.
So is it kind of like mistakenly, buying 5 billion instead of 5 million?
No, our compliance does not allow us to do that, thank goodness. The example I can think of was years ago, there was a double OPI payment and a pension payment on the same day. And I had been rolling overnight up to my 3% max in a few names. And because of that huge drawdown of STIP, I was then over my 3% max. And instead of coming to the board and saying, I made a mistake and I overbought on this day, I instead asked the brokers if we could break the trade so I could stay under my 3% limit. And it would have only been overnight. You know, you guys probably would have understood that there was a huge outflow. I didn't do my math correctly. The compliance didn't catch it because it doesn't see that outflow, but it was in everyone's best interest to break the trade.
It happens from the brokers occasionally too, so I mean,
Yeah.
you know, it's reciprocal.
Yeah.
They may occasionally.
I had one send me a ticket and it had the security had already been sold.
Yeah.
So they had to break the trade because
You have favorite brokers or it's just price based?
some are more pleasant than others, but we trade the same with everyone.
Does the counterparty say that about John?
Notice how no one here.
Well, you had your choice of 3.
I'm gonna say there's a couple that are probably happy that I'm no longer doing it, but.
And there are probably a couple that miss John doing it.
Just getting back, just.
So where were we? Yeah.
Yeah, a couple other things on this screen. If we scroll down and we find a name in blue. So this is basically dealer inventory. So at some point, if we look at just the Apple, Barclays has a piece of Apple expiring 3/18 for, 0 basis points. So if you wanted to proudly say I own Apple for 29 days, you could. We're probably going to pass on that deal. Doesn't seem like a great value. But with the blue names, it does give us an opportunity, to possibly buy a piece of paper from an issuer that's not active. So maybe they were active last week, we didn't have the cash, but now, we can find something on the secondary that is the date that works and also at a rate that works. So just kind of the, again, less flexibility, but sometimes we can find a bargain.
So why would you buy Apple at 0?
You wouldn't.
We wouldn't.
Yeah, right. My guess is that's
I don't know, John said just to say you owned Apple.
Yeah. I did when I was running STIP, brag to my kids, hey, I traded $1 billion this week. Okay, don't really care, but it felt cool to me, yeah.
Where's the vote?
What's in it for me?
Yeah. Just, sorry.
Go ahead.
Just looking at these, so if we're shopping for names, just considerations, liquidity, known cash flows, again, the rates, making sure that it's competitive. Concentrations in the name, I'll touch on that later in the compliance screen. But a lot of times, if you see a great rate, we're probably already full in the name. So, and then asset class, again, we might not be looking at commercial paper. We might just want treasuries today based on what's going on in the market.
Who has access to add or delete the names on your STIP list here?
So the process is that we have our meeting about it, defend the names we want to add, and also go through all the names that aren't changing. Dan Zarling has to sign off on that. And then we send it to operations, usually Tim, to update that. So Tim and Dan Zarling can both go in to AIL here and update. We do not have access to that.
You guys don't have access to do that, okay.
Well, you can see that actually I'm the owner, but we have a handshake agreement with Dan and Tim that we're not gonna go in there and do that.
So you could, because you're the administrator. Is that what you're saying?
Yeah, it's not, I'm not locked out of there, because I 100 years ago built this thing.
These other guys can't.
I guess maybe we
I don't
could.
know
There
that,
isn't,
Clint. I don't know the answer. I've never had.
I don't
try.
think you can.
I don't
I
think you
wouldn't know how to.
That check, that
How we know. Part is because we can see who the last editor of it.
And there's,
Don't come looking for me.
Right.
There was a guy that,
So the-
who did this?
to John's point, this AIL has changed over the years a little bit. And yeah, he created it a million years ago. I don't think you can access it anymore to actually make changes, but maybe you can. I don't know.
Let's just take Anglesey off.
Don't do anything.
I don't know if I could say that I'm not going to, even if it has a
That's okay,
demonstration,
That's okay, I just wondered how that worked.
but yeah.
But there's a tracking there nonetheless that, yeah.
There's an
Who
audit trail on
edited,
all of
who edited what?
So what happens if John, or excuse me, Dan or Tim are gone? Is there a double check with one of them doing it? Do they, is there, or they just have the authority to do it and there's an audit trail, but there is no cross-checking?
So they have to agree with, I mean, so fixed
Right.
income was making the recommendation.
Yep.
They're, you know, I guess. Could Tim or Dan go in and just add or subtract names? I guess they could. I don't know why they would want to one way or the other. And then these guys would probably be looking at it going, why are these names in the list? Because they are looking at it every day. Yeah, there's not the triple check there, I guess, if you will.
But that's just the list.
That's just the list.
Right. When we
It's
get to
not the
the,
actual purchase. of
right, when we get to
They
the
can't-
purchase, there's the triple check or the double check.
There's, right, yeah.
We'll go to the next screen, the BDS. So this is Bloomberg Decision System. This shows all of the securities that we own in STIP. So like I said, 170 today, sorted by maturity date. A lot of data on this screen. So what we're kind of looking at is maturities. Again, we need to know I'm running STIP tomorrow, so I need to kind of have an idea for how much I get to spend. Also, you know, it shows name, CUSIP number, maturity, how big of a position we have, yield, touching on the days to maturity piece. So if John can just kind of hover over that. So you'll see today we're at SEC days. Okay. So we're at 59 days. The policy allows up to 120. So at the time, we never went up. I think 72 was our max. And now we've managed that back down to 60 is kind of the natural flow of thing. If we're buying 90-day and then also longer stuff, 60 is kind of where it settles in.
That's the total in the portfolio.
That's the total in the portfolio.
So John, you said nobody would buy Apple at 0, so scroll down a little bit here.
Okay, you'll let me when you see what do you want to look at Apple?
No, scroll down a little bit. I thought I saw something. Where'd it go?
Yeah, we knew you were gonna call that out,
Yeah.
so.
No,
we
it's
did.
So I think what you're seeing.
I swear I saw
is-
one of the yields at like -3 or something.
That is a prime floater.
Oh, so is that the discount margin?
Yeah.
Okay.
Yeah, maybe it's
There
this
you
one.
go. Oh, that's it. That's the DM.
You guys gotta be on your game now.
Yeah. It
Now, what,
also,
now, wait a minute, what did you say?
It says over on the yield column,
Right.
it says negative 3.16.
So
How
that's
do we buy that?
prime, so that's prime minus 3.16,
Oh,
so
okay.
it's what, 9 basis points today. Prime floaters have looked very attractive to SOFR and Fed funds floaters recently, so that's what I've been buying.
so we'll take this, if you could apply the model. So instead of the messy list of 170 names, we have this model built, which Tim updates for us every day. Puts things in a more natural classification so we can see where the portfolio is positioned. I know. So this is a up-to-date as of this morning list of by category of what we're holding. As I talked about, asset-backed commercial paper, we have a 40% IPS limit, currently at 35%, which is typically between 35 and 39.9 on that. Again, 90 days in allows us to react to interest rate movements. So I wanted a real example. So I went and looked 6 months ago in August, we were buying commercial paper 90 days at 9 basis points was a deal. This morning, we're not accepting basically anything under 50 is not, not a value to us. So that's where in 90 days is, provides liquidity and also allowed to react to market conditions. We've also seen a lot of issuers issuing floating rate paper. Again, there's an imminent interest rate change on the horizon, likely March, possibly as big as 50 basis points. So that kind of gives us protection. Looking at the corporate notes, you'll see SEC days is 1, but days from today is 375. So the difference there is SEC days is till the rate is refixed is the terminology they use. But basically if it's a overnight rate, that's the peg, and then we buy it at SOFR plus 40, then that SOFR, the underlying rate resets every day, and that's the interest rate that we earn. So, a lot of issuers are active there, and so we're buying that. Again, with the protection, it's possibly 2 years note, and we get our returns will move as the overnight rate moves. So
We're holding the note for 3. Is that right?
yeah, on average, this is the weighted average of the final maturity for these corporate notes.
Right.
So we can look in there and
That's
kind of
okay.
see the names, but so that's, again, as a strategic play, we've been more active. When rates were at 0, we still have a rule that we're not buying anything without minimum floor rate interest. So at no point would we be paying interest for holding corporate paper. So
Why does anyone ever do that?
They're afraid that the interest rate will go even lower, below 0.
otherwise, you can, there's happy to answer questions. Basically, you can kind of see by category. Each of them have different characteristics on SEC days. And treasuries, mostly fixed rate, but we're not buying outside of 120 days. And because rates are moving, it's just whether it's March or May, in our opinion. And we could be wrong. We could state. Any questions on this screen? Number the data. All right. So one last screen and we'll put it up. So we're in yellow. We tried not to be in yellow, but
Not red.
so this is our compliance manager screen. This is a list of, well, we've narrowed it down to just one of the rules, but there's what, 100-ish different rules set up to, again, keep us inside the rails. So It prohibits us from making a trade that's outside of our investment policy statement. One example is we have a max ticket of 50 million, so that if I get in there and I try to accidentally buy 500 million of something, a red flag pops up right away and it won't allow that trade. There's also soft warnings, so as we get close to our limit, say a 3% limit, it'll say, all right, this is gonna put you really close, are you sure? So again, a protection there. And if we tried buying a name that wasn't on the list, it's gonna say, no, you can't do that.
So all
So
that happens
all that happens in real time. So this
after
is a-
you hit the green?
It's pre-trade compliance. You saw us pop up that buy screen.
Right,
If we'd have hit that, the compliance will catch it before it goes to the broker.
Yeah.
and then, I mean, so you hit basically the send button. And then you get the screen that says you can't send
Yeah,
this, what
that's it.
happens? That's it?
Well,
You're
That's
done?
it.
that's it. I mean, occasionally there'll be I'm gonna,
Yeah.
sorry, I'm blabbering.
Oh, no, if it's a soft warning, so like you're getting close to your limit, you can say, yes, send it anyways.
Oh, okay.
But if it's a hard limit, I'm over my 3%. I could push it all day, it's not gonna send.
Oh, so that's your protection against the 5 billion instead of 5 million.
That's
I get it.
one of them. And
So
then-
it doesn't leave, essentially, it doesn't leave the,
Right.
right.
Yep, it'll pop up when Tim or Dan come in the morning, they'll see that we tried breaking something and it didn't. allow
Oh, and
it,
then you
so-
get a report?
Yeah, Tim, it actually rings a bell in Tim's.
I'm right
What does
across
he
the
do?
hall from
He
Tim.
like scream down the hall, Kelsey, you've done it again. That's amazing.
If you want to just open that rule and you'll see, these are the names that most attractive rate. The yellow is a soft warning, so we have 3% at time of purchase. So again, we try to buy to 2.9%. Not that it's against policy if we get right to 3%, but again, it shows up in red. Gives Kirsten anxiety, so we try to stay. Even the yellow is a little bit unnerving, so. Yeah. We like it just in the black there in the bottom. So again, we're using all of these screens in real time to manage the STIP portfolio on a daily basis.
Okay, and you've answered this before when you did it, but I apologize, I don't remember the answer. Who builds in the rules?
Yeah, so operations team.
Yeah, Tim operations builds the compliance rules,
Right.
different than that AIL screen that we don't have access to build rules or to override. The investment team doesn't have access to the compliance manager other than to observe the reports.
Pretty amazing system.
So, and tell me this again, so 1 day a week? They're doing it all?
Yes. I mean, they take turns, so every Friday, John or Kelsey is running
Oh, okay.
STIPs, so I get a little extra time in my week, every week.
And then
Sometimes.
Kirsten's here if we have questions and things come up, we can ask her.
You just got a Mai Tai.
I just really enjoy when the brokers come to me, I say, not my problem today, go bug one of them.
And it works the opposite way too.
Yeah.
They'll say, do you want to buy this? I'm like, how about Monday when Kirsten's back? We have an understanding.
It's amazing. Two things are amazing, really. I mean, first of all, this is amazing. Secondly, the interaction. I mean, unless you guys are putting on one hell of a show.
Well, I crossed out my joke. I was going to say, you get to hear from the best looking and most fun team at BOI. but-
How many terminals do you guys have?
We each have one.
I think we've got 12. No, it's 12,000 a year.
I have one, Jason's got one.
Steve's is coming offline.
Steve's is going off. Dan Zarling has one.
Aaron,
Aaron's got one.
Tim,
Tim.
and these four. 10 for now, 9 soon.
Yeah.
And you do not get to count the loss of that toward your efficiency goal for the year.
Yes, I do.
No.
That and the two fact sets.
Well, thank you.
Yeah.
Anybody else have anything for these guys? Once again, it is just as interesting as could be. And I don't know how many times,
Mainly just.
how many times have I been through this?
You know.
You know, and it's just fascinating every time. Recap, to-do list, announcements.
So in April, we'll do the deep dive on domestic equity. We'll have the capital market assumptions.
What was that first one?
We'll do the deep dive on the domestic equity asset class.
All right.
We've got the RVK annual capital market assumptions as well as John's thoughts on capital market assumptions generally. You'll get the memo on benchmarks.
Oh, boy.
Yeah. And then
I'm sure there'll be questions.
we will invite Empira back for any additional follow-up you may have.
Right, and I think if I remember this right, and correct me if I'm wrong, the follow-up that we definitely have to be more from you in terms of what you think.
So as I saw, it, you had staff impact, process and procedures, and any legislative
Right.
changes.
Right.
Would be the 3 things you'd want.
Okay. All right. And then just don't forget that even though the calendar at the back has on the 13th April, we're doing it on the 20th.
Yes.
And then the rest of the times are the same.
No, we moved to December too.
7th, 8th is 6th, 7th. So we'll have a new one of these in your book. We overlap with Empira. Don't want to do that.
December.
December, yep, just back one day,
But-
6, 7, not 7.
May is the same.
May is the same. May and August are both the same, and October.
Hey, anything else? If not, we're adjourned. Thank you all.
So there is one